So you've saved a bit of money and you're ready to invest. But now you're staring at a million different options. You've got stocks, ETFs, crypto, property, startups. Where do you even begin? Don't panic, I've got you. Today, we're breaking it down into a simple roadmap of what Gen Z should actually invest in to build long-term wealth. Welcome back to the Gen Z Millionaire. I'm Ruby, and in this 10-part series, we're making investing simple, accessible, and actually fun. Last time, we talked about setting yourself up for success, getting your mindset right, and building a checklist before you even think about investing. And now that you've got those basics covered, let's answer the big question. What should you actually put your money into? And the good news is, as Gen Z, we have a massive advantage when it comes to risk. Before I get into the specific assets that you can invest in as a Gen Z, I want to talk about a portfolio split. A portfolio split is basically a fancy way of explaining how you're going to divide up your portfolio, or how you'll allocate the money that you're going to invest. One of the most common splits is the 60-40 split, whereby you put 60% of your money into higher risk, higher growth assets, and 40% is kept in those safe havens that offer a bit more stability. And whilst I think this split is great, if you can afford to take even more risk, and you're not going to freak out when those charts turn red, you could opt for an 80-20 split. This is probably the highest growth split that I would personally recommend. And it basically involves putting 80% of your portfolio towards those high growth but very high risk assets like startups, AI stocks, tech stocks, and even crypto. And then keeping just 20% in those safe havens like gold and bonds. The reason that I personally like this split is because it gives you a huge opportunity for growth. Whilst that 80% will be very volatile, it also comes with a lot of potential. And you still have that 20% there to keep things afloat when the markets get a bit rocky. But like I said, if you do opt for a split like this, you need to be prepared to see red. You can't freak out as soon as the market turns or as soon as you see a negative headline. You need to be able to look at things long term and handle your emotions when prices go down. And just trust that over time, it'll have your back. If you are a little less risk tolerant but you still want growth, then that 60-40 split is probably the best solution for you. It still comes with a lot of opportunity to see growth over time, but a larger portion of your portfolio is kept in those less volatile assets. And if the idea of putting your money at risk really scares you, you could opt for a 50-50 split, whereby 50% of your money is put into those higher growth, higher risk assets, and 50% is kept nice and safe in things like bonds and gold. But I will take a moment to say here that just because bonds, gold, and even cash are called safe haven assets does not mean that they do not come with any risk. Your money is always at risk with investing, and that's really important to understand. The reason that I personally recommend these slightly higher risk portfolio splits for Gen Z is because if you're under the age of 35, you have quite a lot of time for your money to grow. There is also a chance that you don't yet have those huge responsibilities like children or a mortgage, so you can afford to take a little bit more risk with your money. But again, your risk tolerance is completely up to you. And if you're not comfortable with volatility, maybe consider a split that leaves you less exposed to those red days. Before you decide how to split your portfolio, I recommend doing a financial audit. Take a look at all of your current expenses and how much cushion or extra money you have left in your paycheck at the end of the month. Also consider your savings. Do you have enough savings to cover 3 to 6 months of living expenses? If not, I would take a look at that first. And then there are other things to keep in mind. Whether you're in debt, whether you have children, whether you have a mortgage, whether you pay rent, all of these things should be considered before you choose your portfolio split. Now that we've explained how to divvy up your money, let's look at the individual assets that you can invest in. First of all, I want to talk about ETFs. ETF stands for Exchange Traded Fund. And it's basically just a basket of different investments that you can trade under one ticker symbol. So instead of buying just one stock, you buy a whole group of them in one go. It's a bit like buying a pick-a-mix instead of just choosing one bag of sweets. And ETFs are incredibly popular amongst investors because it's a really easy way to diversify. And diversification is key because when your money is spread across different stocks and shares, you're not relying on just one company to perform well, which leaves you a lot less exposed to that one company's performance. When you invest in an ETF, if one company in that ETF has a bad year, there's a chance that the others might have a good year and balance out those losses. I personally always opt for ETFs rather than buying individual stocks, just because I think it makes so much more sense, especially if you don't have huge amounts of capital to invest in the first place. And there are tons of different types of ETFs out there. AI ETFs, gold ETFs, tech ETFs, clean energy ETFs, and ETFs that track specific market indexes, like the FTSE 100, which tracks the biggest 100 stocks on the UK stock market. When you buy this ETF, you gain exposure to all 100 of those stocks. Next, I want to talk about emerging markets because I personally think that this is a really exciting investing opportunity right now. Emerging markets are fast-growing countries like India, Brazil, Vietnam. These economies are expanding quickly, and businesses are starting to thrive. Investing in these markets can offer huge growth opportunities compared to developed countries like the US or the UK. However, they are also a lot riskier. Politics can be shaky, there are frequent currency changes, and the economies are typically more unstable. Another relatively high-growth opportunity is investing in startups. A lot of people think that only rich investors can invest in startups, but thanks to crowdfunding platforms, individual investors just like you can put your money into early-stage companies that you believe have the potential to take off. I mean, imagine if you'd invested in something like TikTok, Facebook, or Tesla before those companies got big. But unsurprisingly, investing in startups comes with a lot of risk. A lot of startups fail, but the ones that succeed could really change your life. The key here is to do thorough research. Spend a lot of time looking at the company's fundamentals and really understand how it will make its money. Startups is definitely a place for a smaller allocation of your money, but it's a really fun and quite exciting way to diversify your portfolio and see potential returns. The reason that I've covered a few relatively high-risk investments in this video is because Gen Z can afford to take more risks than any other age group. And this is because we've got time. If you're in your 20s or even your early 30s, you have got decades to let your money grow and recover from mistakes. And that's something that investors in their 50s and 60s simply don't have. So if you're going to try your hand at those slightly higher risk investments, now is the right time to do it. But the most important thing that I want to share with you all today is the importance of understanding what you're investing in. Do not put your money into anything that you cannot explain to a friend. And this is so important because a large part of making informed investing decisions is being able to understand news, events, and company updates. If you don't understand how that company works or how it makes money, it will be really, really difficult for you to make those informed decisions. My top tip is to invest in what you know. Think about companies that you regularly use in your day-to-day life and invest in those. It will be so much easier for you to understand how that company operates and to get an idea of whether it's doing well or not. In the next episode, we're going to be diving into the magic of compound interest, which is how your money can literally make money in your sleep. This is going to be a super interesting video and will shed light on why you do not need tons and tons of money to start investing. If you've enjoyed this video, make sure to hit subscribe and comment with the craziest startup idea that you would invest in. And I'll see you in episode 3.